Hey everyone, Dan here. Hope you're well. Today, we're diving into one of the most important and emotionally charged topics when it comes to retirement planning, inheritance tax, and specifically how to avoid paying it. Now, with the impending budget here in the UK, there is mounting speculation that inheritance tax may become more penalised. So, if you want to pass down your hard-earned wealth without a big chunk going to the taxman and the government, you're in the right place. And make sure you stick around to the end for maybe what will be a controversial but really important bonus tip that can help you maximise your legacy. So firstly, let's look at what is inheritance tax. So inheritance tax is the tax charged on the estate of someone who's passed away. In the UK, for an individual, anything above £325,000, which is called your nil rate band, is subject to a 40% tax unless you plan carefully. You may also be able to benefit from what they call the residence nil rate band of £175,000 if you pass your property onto a direct descendant, which will typically be your children or grandchildren. So there is a potential of having £500,000, £500,000 of allowance before you pay any tax. In addition, when you pass away, you pass any of your nil rate bands that have been unused to your surviving spouse, which ultimately could mean as a couple, you may have up to £1 million of nil rate band available before any tax is paid. With these nil rate bands having been and continue to be frozen in terms of the amounts that they are, alongside increases in property and investment values, many more people will fall into this tax trap. And there is potential for big chunks of your wealth that could go to the government. And that, especially at the moment, is not that appealing to anyone. But today, I'll show you smart and simple ways in which you can avoid it. So strategy 1, spend your money. The first thing you need to understand is if it ain't there, it can't be taxed. Sounds simple, right? Well, one of the best ways to avoid inheritance tax is to spend your money. It sounds simple, but if you have watched any of my other videos, you would have heard me talk about how many retirees struggle to spend their money over the course of their retirement. And just a recap on those studies, on average, over a 30-year time frame, people only get through between 30 and 40% of their starting net wealth, excluding their house. So you must enjoy your retirement, travel the world, upgrade your home, or even spend it on experiences with loved ones. Anything you spend before you pass away won't be subject to inheritance tax. Strategy 2, gifting money. Another key strategy is giving away money during your lifetime. The good news is there are several tax-free ways to do this. Firstly, everybody gets what's called the annual exemption. You can give away £3,000 each year tax-free. If you haven't used last year's allowance, you can carry that forward to this year and give away £6,000. You also get the small gifts exemption, which means you can give up to £250 to as many people as you like each year. You also get gifts on marriage exemption, which means you can give larger gifts to children and grandchildren getting married completely tax-free. Ultimately, you are able to give away as much as you like, including cash, investments, income, property, and other assets. You've just got to make sure you don't die within 7 years of the gift. I know it's slightly uncontrollable, but that's the rule. Because if you give away larger sums and valuable assets and survive those 7 years, they'll be free from inheritance tax too. Essentially, there are 2 categories gifts outside of your permissible allowances just mentioned fall into. They are potentially exempt transfers, or PETs or PETs, and chargeable lifetime transfers, or CLTs. And it really all depends if the gift is an outright gift or one that has discretion attached to it. There are also some other nuances around this that are much too much to go into today. So please make sure you seek professional advice when you want to give away larger sums of money or assets. Strategy 3 is setting up trusts. So gifting leads on to maybe a more advanced strategy of setting up trusts. Trust can be an excellent way to protect your assets and keep them out of the inheritance tax calculation. You're essentially handing control of your assets to trustees who manage them for your beneficiaries. There are different types of trusts and each one works a little differently, but they can help reduce or even avoid inheritance tax dependent on your situation. Essentially, there are two types of trust: a bare trust, where most of the outright, potentially exempt transfers will sit, and a discretionary trust, where most gifts with discretion or the chargeable lifetime transfers will sit. What gift and trust structure is right for you will ultimately come down to how comfortable you are in giving the money outright to your beneficiary, or if you want to appoint trustees to have jurisdiction over how that gift is used now and in the future. Again, trusts can be very complicated, and if not set up correctly, will cause more harm than do good. So please, once again, seek professional advice when thinking about gifting into and setting up any sort of trust. Strategy 4 is donating to charity. So here's a feel-good way to avoid inheritance tax. Not only do you get to make a positive impact, but the amount you gift to charity instantly falls outside of your estate, and any amount left to charity in your will is also inheritance tax free. And as an extra bonus, if you leave 10% of your estate to charity, the inheritance tax rate on the rest of your estate drops from 40% down to 36%. So you could reduce your tax liability while giving to causes that matter to you. An increasingly popular strategy for gifting is in the form of local community foundations, whereby you can contribute to a pooled fund that local charities can apply to for funding. In addition, and subject to certain minimums, you could look to set up your own charitable foundation through these local communities, which means you have full control over where your donations will go. There are many in the UK. Just do a quick Google search and the local community foundations near you will come up. So here's my bonus tip, maybe slightly controversial for many, and that is downsize your property. Many people are house rich and cash poor, and the value of their house forms a large and significant part of their estate. So why not think about downsizing early on in your retirement? Your home could free up substantial cash to spend, invest, or give away. Plus, you'll have a smaller, lower value, and more manageable home in your later years. So there you have it. Several smart and simple ways to avoid inheritance tax and pass more of your wealth to your loved ones. If you found this video helpful, don't forget to like and subscribe to my channel. Drop any comments below with any questions and I'll be sure to answer them in future videos. Until next time, keep planning for the future and live your best retirement.